Okay. So this is what where we stopped, right? Uh, Price weighted index. Yeah. First, I'll explain what is stock split and other corporate actions. Then I'll begin with this one. Okay. See, uh, stock split. Now, what do you mean by stock split? Stock splits. See, for example, first I'll give you one analogy. Imagine you have this is you have one note currency, Indian rupee, whose value is, assume it is 1,000 rupees. Now, if it is 1,000 rupee, so total value will come to 1,000. So how much So now you are going out to have your breakfast for 50 rupees. So are you going to face any problem over here carrying 1,000 rupee to have your breakfast for 50 rupees?
No.
You will face change problem,
Yes.
right? So the problem that you are going to face is what? Change, liquidity problem, change. So what you are doing is you are going to some shopkeeper and you are asking for change. Now the shopkeeper is giving you two notes, imagine. So when he is giving two notes, does that mean your total amount will become 2,000 now? No, right? It will still be what? 1,000 only. So then what will be the change? The change will be value per note will come down to 500. So what has happened over here? It has been split into two parts. Okay, and then you will carry your 500 rupee notes, and then probably now you will be able to get the food. Similarly, so what has happened over here? This is solving your liquidity issues. Liquidity issues. It is bringing in more liquidity into the market. Similarly, now imagine. Uh, Similarly, imagine there is a stock. Okay. Now this stock quantity, you have stock one. Its value is 1,000 rupee, and total value 1,000 rupees. Now when the stock has reached to 1,000 rupees, quite possible that there might be many people who are interested in this stock, but they have only uh, maybe like uh, maybe like 500 rupees, imagine. So but they are not so for that reason they are not able to buy this share, and even the seller is not able to sell it to them, and the buyer is not able to buy because they have 500 rupees note. So this will create liquidity issue in the market. So in order to address this issue, board of directors will come up with stock split. So what do you mean by stock split here? Stock split means they will split the stocks. That means electronically the records will change in the system. Instead of one, after this stock split happens, instead of one share you will have two shares. Let's say if they go for 2:1, that means two shares for one share they are giving. But then that doesn't mean there will be any change as far as the final output is concerned. Output will remain the same, 1,000. So what will happen over here? Value per note will come down to 500 rupees. Okay, value per note will come down to 500 rupees. Okay. Yeah. Okay, so what is the company doing over here? They are doing stock split. Okay, now in this case, only it is addressing the liquidity problem. Otherwise, there is no problem at all. Okay, so here, say for example, see the story ends here as far as stock split is concerned. But let me just elaborate little more. If you are coming with accounting background, probably you can understand even more for better conviction. See, say for example, this company had 1,000 shares, equity shares, and they were paying, imagine initially 20 percentage dividend. If they were paying initially 20 percentage dividend, what does that mean? 20 by 100 into face value. So that means 20 by 100, if face value is 10 rupees, then they are paying 2 rupees per share. If they are paying 2 rupees per share, okay, if they are paying 2 rupees per share, that means 1000 shares are there. So overall, how much are they paying? 2000 as dividend. So 2000 rupees is paid as dividend. Okay. Now after the stock split, what happens? Now after the stock split, again they are paying 20% dividend. Imagine. Now that means 20 divided by 100 into face value. Now what happens? In stock split, face value will also proportionately come down. So if initially face value was 10 rupees, now the face value will come down to 5 rupees. So now 520, it becomes 1 per share. 1 per share into now how many shares will be there? 2000 shares are there, right? Because 1 for 1 extra freely given. So finally, the payment is 2000 only. Earlier also 2000, now also 2000. So there is no monetary shock that the company is getting or anything like that. It is going to be everything same. Only face value will change from 10 rupees before to 5 rupees over here. Okay. Is this fine? Have you understood this one? This is stock split. Is this okay?
Yes, sir.
Yeah, fine. Okay. Now, if since I'm talking about this stock split, let me talk about bonus also. So now bonus. Bonus means what? Bonus is in, let's say again, quantity 1, price is 1000. So total value is 1000. So bonus is, imagine company is giving bonus 1 for 1 free. So when they are giving 1 for 1 free, so you will get 2 shares now. So now when they are giving, when you are getting 1 extra shares, so total number of shares in your account is how much? 2. So does that mean here it will become 2000? No, it will be 1000 only. Okay, if it is 1000, then how is it coming to 1000? You have 2 shares. That is because price per share will come down to 500. So now you see price per share will come down to 500. So bonus is nothing but just a kind of, you can even say fooling the people or just making them to feel good. But practically, they are not getting anything here. The total amount will remain the same. See this difference. See this one. Both are same. There is no difference. Then what is the difference between stock split and bonus? That should be the next question. There is one thin line between stock split and bonus. Stock bonus is sending a very positive signal to the market, but only the positive signal now. Otherwise, it's not that investors are getting double amount in their account, nothing like that. Double shares they are getting, but not the amount. Amount will proportionately come down over here. See, from 1000 it has come to 500. Okay. Now let's see how it works over here. See here, if they 1000, imagine 1000 shares they have, and 20% dividend, company pays dividend. So 20 by 100 into now face value. So 20 by 100 into face value is 10 rupees. Okay. So this comes to 2 per share into 1000. 1000 shares. Okay. So this comes to 2000. Okay. 2000 rupees paid as dividend. Okay. Then Now case 2. Now case 2, this 1000 is becoming 2000 shares now because bonus has been given. Now company says imagine 20% dividend like before. Now you see what happens here. Now because these are all new shares given, the face value does not change. Earlier same shares only split. So here the face value will remain the same as 10 only. So now you see this is again coming to 2 per share. 2 per share into, now we have 2000 shares. So that is coming to what? 4000 rupees. 4000 paid if they have to maintain this ratio of 20 percentage, they have to pay 4000 as dividend. So it is just telling you, it is giving a positive signal to the market that we are taking more commitment and we are going to, we are planning for some big expansion. That is the only signal it is giving. Also, accounting point of view, bonus, when bonus is issued, how is accounting done? Accounting point of view, uh, it will be general reserve. Money is taken out from general reserve. So general reserve account debit to bonus issue account credit, and then bonus issue account debit to equity capital. In short, this debit credit gets cancelled. So general reserve to equity capital, money has been transferred from general reserve account to equity capital. Okay, so that means now it has been transferred to the equity capital. Now company can use this capital for the further expansion of the business. This is the accounting entry. So this is what happens. Practically, investors will not get anything. It is just a good signal to the investors. But if company really does very well, then this share price will go up highly in future, and then people can get benefit. But otherwise, at that moment, they are not going to get any benefit out of this. It is just a positive signal. Have you understood the difference between stock split and bonus?
Yes, sir. Got it.
Yes, sir.
Yeah. Okay. So I have a video also on all these things. Uh, Wait, I'll just write down separately. Anyways, this is also there, but all these video, as I said, almost all videos I have put up already. Okay. This is stock split, right? Okay. So, yeah. So I have to send stock split and bonus video. Okay. Yeah. Yeah. Now we'll come to our topic now. Price weighted index, equal weighted index, market capitalization index. So let me first begin with market capitalization. Okay, that will be more interesting because that is something related to us. So market capitalization, where is it? Hmm. See, market capitalization means what, see, now I'll tell you about India's this one index. So we have uh, Sensex and we have Nifty. So I'll tell you the history about this. See, long back, uh, we uh, normally you see uh, where there are too many banyan trees. If you have observed in remote villages and all, that place becomes the hub of market. Okay, because generally people assemble over there, come over there, and then slowly that place becomes the hub of market. Similarly, over here also in Fort, people used to assemble, and then they used to discuss trade, and then they used to buy and sell. There were all banyan trees at that time over there in Fort. So people would assemble, they would speak about this uh, buying, selling, and then brokers also started coming up over there, and then slowly that lane was named as Dalal Street. Dalal means broker street. And then uh, you know like in a school, when your teacher is teaching you, imagine now teacher would also be interested to know how many people have understood. So what will she do? She will take some test, or she will ask you. Okay, similarly here also they wanted to know, that time uh, 1000 plus companies are listed. Okay, so that time 1000 plus companies are listed. At that time 1000 plus companies were listed. So they wanted to know how these companies are performing overall, just like teacher wants to know whether my class is understanding or not. Similarly, they wanted to know whether this overall these companies are doing very well or not. Now there is a concept called market capitalization. Market capitalization means what? Market capitalization is equal to, market capitalization is uh, number of shares, outstanding. That means number of shares in the market into price per share. So if number of shares are, imagine, crores of shares will be there, but I'm just taking simple example, 10,000 shares, and price per share is, imagine, price per share is 50. So market capitalization is 1 2 3 4 5 lakh. Market capitalization is 5 lakh. Okay, market capitalization is 5 lakh. Okay, so and then tomorrow, imagine if the price goes to 51, then it will become 5 lakh 10,000. Okay, so like this every day it will keep changing, market capitalization. Okay, so now they wanted to check the market capitalization of all the companies listed. But then the problem is, practically the price, the market capitalization of one company would go in billions. When market capitalization of one company is going in billions, just imagine 1000 plus company listed, what will be the market capitalization of all those 1000 companies? So it will be a too big number to track daily. So they thought, let's go for some samples. Like in a class, your teacher cannot ask each and every student, have you understood? So what will she do? She will ask two, three, four people in the batch, right? And if two, three, four people are answering, that means entire batch has understood. And if they are not answering, that means the batch has not understood. So that's how she will be able to judge whether people are able to understand or not. Similarly, the research shows that when you want to take sample, that means she is taking sample and then checking. Similarly, here also they thought, we'll take sample and check them, because we cannot take all the companies. It will be, too big number. So the research says that if you take sample, you should take minimum 30. That's what the research says. So accordingly, they took top 30 companies. They took top 30 companies. Why did they take top 30 companies only? Because the assumption is, if top 30 companies are doing well, the remaining companies are also doing well. That is the assumption. Like why? How so? Reason being, these smaller companies will be the vendor for the bigger companies. Say for example, Tata Motors. Now Tata Motor is, if doing very well, that means Seat Tire must be doing very well. They only must be, you know, selling tires to Tata Motors, right? So that means these are all like ancillaries making companies here, and these are all the brands which people know about. Okay, so these ancillaries making companies, they are doing very well. if Tata Motor is also doing very well. That is the assumption. Okay. So keeping this in mind, they selected top 30 companies. Now the problem is the market capitalization of these top 30 companies is also too big. Market capitalization of this top 30 companies is also too big. So what to do now? Say for example, I'll take one example, like it is 10 lakh. Imagine it's a very small number I'm taking so that it is easier to calculate. Otherwise, again, practically it will go into billions. So 10 lakh. So yeah. So imagine the formula goes like this. What they did, they converted this 10 lakhs into some numbers because practically it was going in billions. So it came to like this market, uh, yeah, new market capitalization divided by old market capitalization into the base number. So whatever they gave this index a base number as 100. So let's say in this case, old market capitalization is 10 lakhs, right? And this number is represented with 100. What is this 100? It represents points. Okay, points. So now imagine the new market capitalization, because every day the market capitalization will change, the price will change. Imagine it has gone to 11 lakhs. If it has gone to 11 lakhs, then so if I calculate, this comes to what? 5, 5, this 110. Okay, 110. So that means 100 has become 110 now. Okay, 100 has become 110. Okay, initially it was 100, it has become 110. So there will be news that this index has gone up by 10 points. Now imagine next day, this 11 lakh will become the old market capitalization. And so the new market capitalization is, imagine it has gone up by, let's say, gone up to 14 lakhs. Now this 11 lakh represents what? 110 points. So cancelling all this, 140. So there will be news that index has gone up by 30 points. Now every day index may not go up, right? So let's say imagine it has come down. So this is 14 lakh, new will become old, and this is 13 lakh. So this 14 lakh represents 140. Okay. So this is 130. So now index is coming down by 10 points. So they thought, this index is very sensitive. This index is very sensitive. Okay, so this is a very, very sensitive index. And they had to name this index. So they named this index as sense, and this is X. So they have taken name like this, and then they made it what? Sensex. Okay, so Sensex stands for sensitive index. Okay, so it is very sensitive. So like this, Sensex started its journey somewhere in 1979-80, around that time, with 100 points, and then it reached to 110, 140, 130, then 500,000, 10,000, 20,000, 50,000. Now it is hovering around 85,000, something like that. It is hovering around. So this is how Sensex started its journey. And when I say 85,000, what is this? This is representing points, not an amount. Is this clear? Is this clear what
Yes, sir.
Sensex means? And every day when you see newspaper, uh, like Sensex went up by this much, this much. This is what it means. These are all representing points. Okay. I'll just show also this to you here. See, can you see here points changing? PT is points. Okay. and it represents what? Top 30 companies. Okay. So if I want to know all those top 30 companies, I can click over here. These are those 30 companies. So 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6. 6 fives are 30. Okay, so these are those top 30 companies. Okay, yeah. Then if Sensex is going on very well, then why Nifty came into existence? So there is a story for that as well. Why Nifty came into existence? Why Nifty came into existence? Because see, 1980s it was going on well. Only okay, Bombay Stock Exchange was only dominating when it comes to buying and selling of shares. But then as 90s came, you know, people, first of all, there were some problem with the Bombay Stock Exchange. It was like completely controlled by the brokers. So there was a lot of opaqueness because that time there was no electronic age that time came up, right? There was no electronification. So if somebody wants to buy or sell, they have to literally go there to fort, and then they have to talk to the brokers, and then so when they are talking to the brokers, how will the brokers talk? Say for example, imagine you are going to some real estate broker and you are asking for a home on rental basis. You know how the real estate broker will speak? He will say like, look, this home is the last home in the world. If you don't take this home, you are going to be homeless. All that thing, he will try to create fear in your mind, right? That so many people have already seen this home, and everybody has gone just to get the advance payment. You immediately pay the advance, otherwise the you will leave, you will not get this home. They will create fear. Probably you are the first person entering into that home, but then they will create this fear. So similarly, same thing happened in same thing happened for stock exchange also. That when you are going and going to the broker and saying, I want to buy Reliance shares, at what price it is available, they will not tell you the truth. They will say like, Reliance, nobody is ready to sell, only how will you buy them? It is available at a very high price, you have to pay very high price. Imagine the actual price is 100. So they will say that you have to buy a very high price, let's say 120 rupees you have to buy. So now, yeah, but the actual price is 100 only, but you are being made to buy what? 100 and at 120. And similarly, if a seller is coming to sell, then they will say, look, nobody is buying Reliance, so I cannot take it from you. If you still want, you have to sell it at 80. So broker, taking the commission in between, by bringing the opaqueness. So this was troubling the market. Okay, this was troubling the market. So because this was troubling the market, okay, so because this was troubling the market, so in early 90s, some big companies like ICICI Bank, SBI Bank, LIC, HDFC Bank, so this kind of some bigger banks, they joined hands, they came together, and they thought like, and that time only electronic age was coming up, all this computer system was coming up, right? So they thought like, we will create one competitor for the stock exchange. That competitor is National Stock Exchange. Now in this National Stock Exchange, we will create another index. Okay, now that index, they thought like, already Sensex is showing 30 companies, we will take 50 companies to be more precise. So we will take 50 top companies, top 50 companies. Okay, we will take top 50 companies. So and then so this is National Stock Exchanges, uh, National Stock Exchanges 50 companies. National Stock Exchanges 50 companies. Okay. National Stock Exchange is 50 companies. Uh, uh, so, National Stock Exchange is 50 companies. So now they had to name this index. Same concept, okay, market capitalization basis. That means new market capitalization divided by old market capitalization into the base value index. Okay. Now they had to name this. It was started somewhere in 1994, somewhere around at that time, and they took N from here and IFTY from here, and they named this as Nifty. They nicknamed it as Nifty. So this was called Nifty 50. It was called as what? Nifty 50. So Nifty 50 indicates top 50 companies in terms of market capitalization. And what was it offering more unique? That now you don't have to take the help of your broker to know what is the price going on in the market. You use the website, and the website will tell you that the price is available. The Reliance is available at 100. So you don't have to ask the price from your broker. Okay. So that's why then it became very popular because of the transparency that it was bringing to the table. Okay. Plus, uh, they also had many indices. That means then they thought, uh, why not to have Bank Nifty, where it will show only all banking companies performance. Even earlier it happened here also, when Bombay Stock Exchange and Sensex were formed. They thought, okay, now this Sensex is showing the performance of all companies. What if I want to see only banking companies? So they brought in BankX, okay, like Sensex, BankX, then BankX, and then Pharma, FMCG, like this various indices they brought in. Similarly, over here also various indices, Bank Nifty, then FMCG, Pharma, various indices they brought in. But in today's date, there is no difference between Bombay Stock Exchange and National Stock Exchange. They both are offering more or less the same service, because seeing National Stock Exchange, Bombay Stock Exchange also electronized themselves. And so now you go to Bombay Stock Exchange or you go to National Stock Exchange, electronically you will be serviced in a very transparent way. Okay. So this is about market capitalization. Have you understood this one? Any questions, doubts here?
Understood, sir.
Understood. Okay. Okay, fine. Okay. So now let's see this sum. Consider, see this sum, two things has been added to this sum. We will just bifurcate this into two parts, and then we will focus one by one. See, consider three firms described in the following table. Compare the effects on your price weighted index and market capitalization. Price weighted index we will see little later. Market capitalization weighted index, if stock A doubles in price or stock C doubles in price. Assume the period shown in the table is the base period for the market capitalization weighted index, and its base value is 100. Okay, so its base value is 100. Now market capitalization method. So what is the market capitalization? First of all, we'll see here is the given conditions. Number of shares outstanding 100, price per share 100, capitalization. So this multiply this, you will get capitalization, and then this 000. Okay, but you can ignore this. You can write like this also. Company A, B, C. Uh, where is that sum gone? number of shares 100, number of shares outstanding 100, 1000, and then 20,000. Then stock price 110, 1. Okay, so this is the given condition. If I have to calculate the market capitalization, and then they are saying there are two cases. One is stock A doubles and another one is stock C doubles in price. So if stock A doubles, then what will happen? If stock A doubles, this is 100. So it will become 200 and 100 price, number of share. No, sorry. The price is doubling, right? Number of shares will remain the same. So here, so what will happen? First, initially, so new market capitalization divided by old. Old is this one, 100 into 100 plus 1000. So this is shares into price. 1000 into 10 plus 20,000 into 1. Okay, and numerator is 100 into 200 plus, so this is shares, this is price. Then 1000 into 10 plus 20,000 into 1. So, and then the base value is 100. Okay, so you calculate the numerator and the denominator. Calculated.
It's I got 1 lakh 20. Oh, it's 125. Sorry.
Yeah, 125. Shravani, you got it?
Yes, sir.
125, right? So that means 100 has become 125. Okay, that means this index has gone up by 25 points. Okay, now suppose now case 2. Case 2 is what if stock C doubles? Then what would have happened? That means A is 100 shares, these are shares B, C, So this is 100 only. This is, so this becomes 2. Okay, case 2, this one is changing. Okay, so now again you will have to calculate. There is a reason why, this kind of examples are given. Okay, see here, old market capitalization will be the same number. That means these are all old. So 1000 into 100 into 100 plus 1000 into 10.
It's 120. Is it 120?
Uh,
I'm
one.
getting 150.
Acha, you have calculated both numerator and denominator.
Yeah. Uh, I think I made some mistake.
How much you said?
Said 120. Yeah, I got 120.
No, it should be 150.
150.
Yeah. So this is 100 into 100 plus 1000 into 110 plus 20,000 into 2.
Got it. Got it. 150.
150.
Yeah.
Yeah. So now you see, when stock A doubled, stock A is of 100 rupees. That doubled to 200. Stock A is of 100 rupees. That doubled to 200 and it went up by 25 points. Stock C, which is of only 1 rupee, now that doubled and it reached to 150. Why? Because number of shares for stock C is very high, 20,000, and number of shares for stock A is very less, 100. That's why even though stock A doubled, but overall it could not lift the index very high in comparison to stock C. Have you understood this point? So that means,
Yes.
moral of the story here, number of shares are also playing a role in the movement of index value.
Yeah.
Number of shares are also playing a role in the movement of index value. Okay. Number of shares are also playing a role in the movement of index value. Is this fine? Clear?
Yes, sir.
Yes.
Clear.
Okay. Now coming to the price. So why am I speaking about this price? So now coming to, this is market capitalization. Now coming to price weighted index. Price weighted index, you see here, price weighted index is nothing but just the average we have to take. So we are concerned only with the price. Okay, in price weighted index we have got nothing to do with the shares, so we will ignore shares. 100, 10 and 1, and later on they are saying stock A doubles. So if stock A doubles, then it will become 200, then here 10 and 1. So you take the average price of this one, take the average,
$37.
and this, take the average of this one.
31. Oh, 10.33.
This is 200.
Oh, sorry. My bad. I thought it's so sorry. It's 70.33. 70.33.
Okay.
Yeah.
Okay. And another case is, what if stock C doubles? So instead of A is 100 only, this is 10, and stock C doubles. Then you take the average.
It's 37.33 again.
Yeah. Okay. So you see, index is moving from 37 to 73
Yeah.
because when in both the cases, in the first case, stock A is doubling, and in the second case, stock C is doubling. Okay. So when A is doubling, index is moving so highly. This is the index value. This is how it is calculated, just the average. Okay. So you see, index is moving very highly when bigger stock is or expensive stock is going up, whereas the
Right.
smaller one, when see both in both the cases, it has grown up by 100 percentage. But when stock C is growing by 100 percentage and becomes 2, it is hardly making any movement in the index. That means, what is the drawback of this one? The drawback of this price weighted index is that it is biased towards the higher priced
Yeah,
stocks.
like outliers, right?
Yeah, higher price stocks, they will gain more over here. That
Yeah.
means they are dominating the movement. Highly priced stocks are dominating the index movement. Is it okay?
Yes.
This is the drawback. Okay, highly priced stocks. That means, uh, you know, companies price which are not so very highly priced, they are not dominating in the movement of the index. Okay, this is the drawback. So now we will see another example, whereas that drawback is not there in market capitalization. So many companies follow market capitalization only. Okay, here you see that drawback is not there. Now you see, second company has made better move. Second means this company C has made better move, right? That drawback you will not find in market capitalization. Okay, yeah, okay. Um, yeah. So now similarly, let's do one another sum also. Now you see this sum. This is also price weighted index. Just go through this question. Okay. So here, uh, yeah. See here, okay.
Yeah,
So in
got the
this sum,
sum, sir.
you understood?
Yeah. Uh,
Yeah. In this sum, all you have to do is take the average of this one, stock XYZ, stock XYZ, 10, 20, 60. And then, so this is P0 initial, P1 is 20, 15, 40. So average price. How much is the average price? Calculate this one.
30 and this one is 25.
So that means, so index has gone from 30 to 25. It has gone down. By how much it has gone down? If I want to check, closing value divided by opening value minus 1. Just check.
16.7.
This is minus 16.7. It is closing value divided by opening value minus 1. Okay, that's it. This is price weighted index. Now another one is, now why then this price weighted index, where is this followed and all? Market capitalization is followed in our country, as I said, but then our country's question will not come in the exam. So if at all they are asking, they will ask about Standard and Poor 500. This is an index in US which follows market capitalization method. Okay, market capitalization. Then who is following price weighted index? Price weighted index is followed by Dow Jones Industrial Average. That means DJIA. Okay, Dow Jones Industrial Average. Now Dow and Jones, these are two people. Okay, these are their last names. Now there are technical analysts. So that means for technical analysts, what do they require? They require only the price. They don't require anything else. So this is for those people who are least worried about the fundamentals. All they want is only the price movement, and that is enough for them. So if that is the case, you should look at Dow Jones. Okay. Okay. So this is an example for price weighted index. Remember these names. Okay. Price weighted index. Okay. Now coming to, yeah, this one, stock split. Now you should know what is stock split. Just go through this question. Okay. So at the market close on day one, stock A has a price of 10. Stock A has a price of 10. B has a price of 20. And C has a price of 90. The value of a price weighted index of these three stocks are taken the average 40. So average index value is 40. And at the close of trading, if stock C splits 2 for 1, effective on day 2, what is the new denominator for the index? C stock split happens. So this remains 10, this remains 20. What will be the price over here? Remember I said you are not going to get anything extra amount. So the price will come down. Number of shares will go up, but price per share
45.
will come down. It will come down to 45.
45.
Now ideally, what should happen? Take the new average.
25. Yeah.
Ideally, it should be 25, right? Then it will not be 25 over here. Okay, this is the change in stock split. If any this kind of stock split bonus issue happens, what they do is they don't want this kind of changes to affect. So initially it was 40, right? So now also they will do like this. They want this to be 40 only. They would rather change the denominator only. So you find out the value of the denominator now. So it will be 40x is equal to, add up all this, 70, 75, correct? 75. So x is
So
equal to
1
75
point,
by 40. 1 point.
1.875. 1.8.
So that will be the new denominator. So we will change the denominator, but we will not change the outputs when it comes to corporate actions. Like corporate action is a general term, okay, for stock split, bonus, and all such actions taken by the board of directors. We say corporate actions. Okay.
Yes.
Yeah. Okay. Now let's understand the theory. Now, Hmm. Just read this one. So price weighted index is simply an arithmetic average of the prices of the securities included. The divisor of the price weighted index is adjusted for stock split and any changes in the composition of index when securities are added or deleted, such that the index value is unaffected by such changes. Okay, the index value should be unaffected by such changes. The advantage of your price weighted index is that its computation is simple. Okay, simple, right? Only average we have to take. One disadvantage is that given percentage change in the price of higher price stock has greater impact on the index value than does an equal percentage change in the lower price. Can you understand this one? Put another way, higher price stocks have more weight in the calculation of your price weighted index. Okay, higher price stocks have more weight. Additionally, a stock's weight in the index going forward changes if the firm splits its stocks, repurchase or issue stock dividends. Stock dividend means bonus only. Bonus is also called as stock dividends. Okay. A portfolio has an equal number of shares in each of the constituent stocks will have the price return that will match the return of the uh, price weighted index. That means imagine you have one share price, because each one is indicating what one shares price only, right? So if you have one shares of all the stocks, then your portfolio's return will be equal to the returns of the index. Okay, equal number means you take one in this case. And two major indices are Dow Jones is an example, and Nikkei is a famous one in Japan. Okay, they follow price weighted index, and DJIA is a price weighted index on 30 US stocks. Nikkei is constructed and it consists of 225 stocks that trade in Japan. Okay, Tokyo Stock Exchange. Take a minute, go through this again, and ask if you are not convinced anywhere. Very important question. They will not ask the sum of price weighted index, they will ask the theory only. Sum is very simple, just the average, right? So they will ask you something from this theory only. Is it okay?
Yes,
Yes,
sir.
sir.
Okay. See, you both have not registered, right? So do you both have uh, curriculum with you? Curriculum books, do you both have?
Yeah, I have the
Yes, sir.
soft copies.
Yes,
Okay,
sir.
you both have curriculum, right? Okay, so I hope you are doing the module quiz. See, once I finish one subject, uh, I really, would like you to see finishing up. In fact, before I finish the subject itself, I would like you to see, finish. I would like to see finishing up all the questions, because then only I will be able to go ahead. Okay, all the questions, all the doubt solving one, because I'm taking this online, right? But that should not be the excuse for me to compromise on quality. In fact, I would like to put now more pressure on quality. So that's why I will not go to the next subject till you finish all the questions and all doubt solving one. You should get this conviction that okay, like, even though I have done this online, but I'm able to score very well in all the questions. That conviction you should get. Otherwise I will keep going, we're ticking all the boxes saying I have done all these subjects, but you will lose confidence later on. And the intention is not to finish my work, the intention is that you should pass. Okay, so please go to the curriculum and then start solving all the questions and come with your doubts. Okay, then only you will be able to learn further. Only this Schwezer learning is not enough. Okay. Yeah. Okay, then next one is equal weighted index. Now the drawback in price weighted index is what? That higher price stocks gets more weightage. So that is rectified in equal weighted index. Equal weighted index is another one. Let's do the sum first, then we will go to the theory. So market capitalization, all we have done. Now you do this one, equal weighting. Just go through this question. Actually, this is not a part of the question. Only this, that last column you ignore. Only initial price and current price. So we have to find out equal weighted index. Equal weighted index for the three stocks. Okay. Now equal weighted index. Equal weighted index is the stock A, B, C, 1252 38, 1252 38, 1548 45. So equal weighted index, how will I do? Acha, if I have to do price weighted index, how will I do here? Can you calculate and tell me price weighted index? All I have to do is what? Average, average. Take the average.
Yes, sir. It's 34.
Next one
15.
is 48. Okay.
It's 36.
36. Okay, so 36 by 34 minus 1.
6 by 34 minus 1 is, I think it's 5.88. Yeah, 5.
Okay, fine. Okay, now this is price weighted index. Now equal weighted index is what here. Equal weighted, why it is called as equal weighted? Equal weighted means as if like you are putting equal amount in all the stocks irrespective of its price. So 100 rupees for each stock, that means it's a percent. So imagine you have put 100 rupees, then by what is the return you are going to get? So for first one it will be 15 by 12 minus 1. Just calculate it. 15 by 12 minus 1,
0.25.
that means 25 percentage, no? Then this one
Yes, 25.
48 by 52 minus 1. Hmm? Hmm? How much? Hello.
Yes, sir. Hello.
Hello. How much?
Yeah, yeah. It's 48. Yes, sir. I think 7.69.
This is in minus.
Yeah, minus
Third one.
45. It's 18.42.
Okay. So equal weighted index means you will calculate like this individually, as if like you have invested 100, and then you will take the average of all this. So 25 percentage minus 7.69 percentage plus 18.42 percentage divided by 3.
9.11.
Okay. So that means index is going up by 9.11. Okay. But here they are saying 11. Wait. Acha, that is because this is 7.7 they have taken. It's okay. Plus 25 minus 7, 18.44. Acha, they have taken this 18.44. That's okay. All these are decimal problem then. Okay. So that comes to 11.9 percentage. And they mentioned that initial index is 131. So the new index is growing by 11.9 percentage. So the new index value is 131 into 1 plus 11.9 percentage. Let's calculate this. 1 plus 11.9 percentage.
146.58.
This is the new index value. 146.5.
131 was given. Okay.
Yeah, 131 was given.
Mhm.
So here, what is happening here? Uh, everybody, is getting equal opportunity. So when everybody is getting equal opportunity, the smaller one will feel more powerful, or else bigger stocks. Hmm? The
Sorry.
smaller, when everybody is given equal amount,
Yes.
the smaller companies will feel more powerful. If you give equal amount of food to a 5-year kid and to a 20-year person, who will end up eating more and more? A 5-year kid, right?
Yeah.
So you are giving equal food to them, but for a 5-year kid, that's a big thing, big amount.
Yes.
Similarly, for a small stock, when you are investing in 100 rupees, that is getting more weightage now in the index.
Right.
Okay, so that is the plus point of equal weighted index. See this one, just read this.
So they are saying that it has the same effect, right? Regardless of the size of the company. Hello? So I can't hear you.
Hello.
Yeah, you're audible.
Yeah. So are you clear with the?
So it says that regardless of the size of the company, like the effect is the same, right? Yes.
Ha. So automatically that drawback gets eroded here.
Okay.
Yeah.
Yeah.
Okay. So now further theory. Now you read this theory. Okay.
Yes,
Then
sir.
one complication with an equal index return is that matching a portfolio would have an equally adjusted or rebalanced as price changes so that the value of all security positions are made equal each period. See, that is an important point. What it means is if you try to match, because here the assumption is every time you are giving 100 rupees, but then what happens, every time, see, now 100 rupees we have given, this has grown up maximum, but now when this has grown up maximum, now further, the weightage will change again. So every time you have to, periodically you have to keep on readjusting. So that means whichever stock price has gone overly high, you have to, sell those one and invest into those companies which has not done well. So that way you have to keep on doing rebalancing all the time. That is one drawback here. So this question can be asked like, which method you will end up doing more maximum number of rebalancing as the price changes. Okay. And that will lead to more cost also. So transaction cost more in equity equal weighted index, and also rebalancing more in equal weighted index. Okay. Another concern with equal weighted index is that weights placed on the returns of the securities of smaller capitalization are greater. As I said, a 5-year kid will get more food if you give equal money or equal amount, equal food to both 5-year and 20-year. Okay. So conversely, the weight on the returns of larger capitalization firms in the index are smaller. Okay. So here, smaller companies are getting more power, bigger companies are getting less power here. And where is this followed? It is followed in this index. Value line composite average and Financial Times ordinary share index are well known examples of equal weighted index. Okay. Then next one, market capitalization. Now this also we have done now already. Now I'll just tell you the difference. What do you mean by this market capitalization and free float market capitalization? See, free float means it shows number of shares which are available for trading. What do you mean by that? See, market cap, generally market capitalization means it will take into factor market capitalization weighted index means all the shares. It is also called value weighted index. Okay, both are same. Remember this name also, value weighted index. Now, market capitalization weighted index means it will take all the shares, okay, issued by the company. But out of all the shares, imagine 60% shares is held with the promoter. Then promoter is not going to sell. It is not even available for trading. So only 40% will be available for trading then. So free float market capitalization means it will take into factor only those 40%. Okay, it will take into factor only those 40%. That is free float market capitalization. Okay. Free float market capitalization. Okay, that's the only difference. Otherwise, see, theory point of view, you will get questions only from uh, equal weighted index or else price weighted index. uh, Market capitalization weighted index, you will get more likely sums only, but still you may read this part. At least you may read. Yes, you may quickly read this one. Is it okay? You are able to understand all this?
Yes, sir.
Yeah. Okay. So free float means, as I said, so even DII, FII, whatever shares they are keeping, they all fall under free float because those are all held for trading purpose only. Okay. Only promoter held will not be used here.
So in market capitalization weighted index, like the stocks are there as per the like the indices, right?
Huh.
Like,
Yeah. Yeah. Okay. Then Standard and Poor is the example of market capitalization index. Then fundamental weighting. These are some other, ways to value the index. So fundamental weightings are used. Fundamental weighting here, I don't know any specific company, but here it says, I have to check that one. Here it says earnings, dividends, cash flows. On this basis, it will be valued. They give weights on this basis. In contrast, market capitalization, they here they put weight on the shares, right? Here they put weight on the fundamentals like earnings, dividends, and cash flows. Okay, and it can also be based on single measure or combinations of fundamental measures. So all these combinations they can use: earning, dividend, cash flow, all this. Uh, the advantage of fundamental weighted index is that it avoids the bias of market capitalization weighted index towards the performance of shares of overvalue. So here this is a problem with market capitalization, that overvalued shares will take more weight. So that is avoided here, and away from the performance of undervalued. So this is a good point. This is a drawback of market capitalization index. Your fundamental weighted index will actually have a tilt, value tilt. That means overweighted firms with high value metrics such as book to market ratios or earnings yield, uh, high earning relative to index will by construction have a higher weight in the earnings. A fundamental weighted index will actually have a value tilt. Okay, value tilt. Acha, this is the drawback of fundamental weighting. Higher value will be more valued. Overweighting firms with high value based metrics such as book to market value or earnings yield. Okay, that is their nature. Tilted towards value. Market capitalization is tilted towards overvalued shares. So everything has its own plus minus points. Okay. Any questions here till here?
So can you explain value tilt again? Like what do they
Yeah,
mean?
yeah. Value tilt means the weightage will be based on uh, the the fundamentals. That means wherever the earning is high, they will get
Okay.
more weightage. On that basis, it will be valued. But exact calculation, all those things we don't have it in the curriculum.
Okay. Okay.
Yeah,
So can we like conclude the lecture today? Like,
yeah, yeah. We'll stop now here. Okay,
yeah.
fine. We'll stop it here. And yeah, so please read and go to the curriculum also. Do the model quiz. Okay, and then now after this we'll start with. Please do this model quiz also in the Schweizer, and then next time we'll start from here. Fine.
Okay.
Okay, we'll
Okay.
stop
No.
now.